Good morning. Mike Yonkman, Chief Investment Officer for Ankerstar Wealth, giving you your weekend recap update. If you are enjoying your summer and you're saying it's green and it's beautiful out and you haven't looked at the markets this week, just go ahead and stop playing this right now and just enjoy your time. In the long term, the markets go up. But in the short term, we can have volatility, which we have. So today I'm going to cover a little bit of what's happened this past week. I'm going to cover the unemployment number, some credit card debt for the consumer, and just kind of show you a slide of what things can look like long term as far as pullbacks. But before I get started, I must remind you this is a financial education presentation. You must do your own due diligence on anything that you hear in this presentation. More information can be found on ankerstarwealth.com for disclaimers, and the opinions expressed are mine and mine alone. So just a reminder, if you're just enjoying summer and you have full trust in us to manage your portfolios and you just want to not worry about these downturns, that's our job. And we are certainly glad to do it and paying attention to this daily. And you don't need to watch the rest of us. But if you would like to understand a little bit more about what's going on, here we go. So this graph that I'm showing on the screen is the week for S&P 500. It is down. You can, when you look at it just on a week or a month, actually this is just a month, it looks like, wow, that's down a lot. But let me show you just on a year to date what this looks like. And you can see on a year to date basis, you can certainly see the drop at the end, but overall year to date it is up, I think about 12%. Let's see, a little bit more than that. So S&P, but we are definitely for the more aggressive portfolios a little heavier in the tech side. So what has happened in tech this week? The graph looks very similar. Big drop in the last few days. In fact, the week was really interesting. It was a big drop, a big recovery, and then 2 days of big drops. So as quiet as this entire year had been, all of a sudden this week we got volatility. It hit us, hit the markets hard. And that's the way volatility works. But let's look at the Nasdaq on the overall year. You can see that once again, certainly you can see the drop during July, and the Nasdaq is officially down 10% from the high. So I believe the high was July 10th. And believe me, I like nothing more on the weekends to come in and say, we're at new highs, we're at new highs. I think I did that like 5 weeks in a row. And it was so easy and I loved it. But, we got to be realistic. There's times that it goes down. So it is 10%. So it's considered correction territory. So is it going to continue to go down? We shall see, because I'm about to hit the economy. One other thing, and I pulled this, this is interesting to look at the Russell 2000, which is the 2000 smallest companies. And if you look at a year to date on them, you're actually seeing it was pretty flat most of the year, but they've actually come up towards the end of the year. And this is actually a good sign to see some sector rotation and the overall stock market doing well rather than just 10 stocks. What caused this week? So when I look at this graph, and this is just a 1 year graph of the unemployment number, it looks terrible, right? The unemployment's going up, but beware of a graph that only shows from 3.5 to 4.3%. Let's back this thing up and let's look at a 10-year unemployment graph. And you can see obviously the big spike for COVID, but you can see that overall the unemployment rate at 4.3%, while certainly trending up, is not crazy, out of whack for times. And when I look at max, and you pull this thing back to like 70 years, you can see there's different business cycles. That COVID spike obviously looks scary, but there's different business cycles where we have different unemployment rates, and you can see that there's definitely an uptick happening. In fact, I want to say it's 5 months in a row that we went up. So it's up to 4.3%. I am actually more concerned about what I'm going to show you next. This is the total credit card balance from 1999 to basically present. And you can see there was a dip during COVID when the government, basically issued money They went down, but you can see credit card balances at an all-time high. That is concerning. You could almost think this was our national debt, which is also at an all-time high. More concerning, though, is the delinquency rate. So credit cards that are 60 days past due. That's what this graph is. And you can see that it is going up, and it's really at its high since, almost 2010, 2012. So that means consumers, all of us, people are starting to hold money on their credit card longer and get behind. That is very concerning when coupled with increasing unemployment. But let me back up because I want to close on some positive news. This graph that I'm showing you here is this is the S&P 500, and it shows the gray bars are what it did each year, but the red number is how much it declined in a year. So like last year, the market was up 24%, but at one point it was 10% off its highs. Now we're looking at the Nasdaq now. It's 10% off its high from July 10th. So that's a quick drop, but it tends to recover. So, I just look at this as a positive thing to close on. And then I'll just, mention here that, there's worries about this being in correction territory. I know that we've talked this year about limited number of Fed rate cuts. I think this basically cements in they're probably going to lower the rate in September when they meet next. And I like this quote this guy had. This is just an old-fashioned correction going on. So this is normal in stock markets that things go up and down. You have volatility. Is it a buying opportunity? It is in some positions. We'll see which ones, and that's some of the things that we'll be making decisions over the next few coming weeks. One thing is in your portfolios, you probably noticed since July, we have been de-risking. So you'll see, companies or USFR, Vanguard long-term bonds, a buffer, which is like a buffered ETF of the S&P 500. You're going to see positions like that. You have seen positions like that, and you'll probably see more as we go through this volatile period. So with that, I hope you have a great weekend. We will continue to watch these markets closely and monitor your positions. Thank you. Bye.